Real estate as a whole hasn't performed that well, with many real estate ETFs being down year to date despite the overall market rally. This has caused concern for many real estate stock investors, as although many of these stocks pay high dividends, this potentially unexpected drop in market cap has been scary. One of these stocks that has been receiving the most attention in this category has been Realty Income, ticker O. This stock has been a real estate investing staple in the stock market over the past few decades, but a year to date drop of 15.7% has caused many investors to be wary. So is this drop in market valuation a good time to pick up new shares and add to your income, or is there genuinely a good reason that this stock has performed so badly? Well, in this video, I plan to talk about the reasons behind this stock drop and whether I think it will continue or whether the market has truly overreacted. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. Firstly, let us talk about what Realty Income is and how they make their money. Realty Income is a REIT that makes cash from long-term net lease agreements with over 13,100 real estate properties around the world. The majority of their properties are in the United States and a few countries in Europe, that being Spain, the UK, and Italy. This isn't real estate as in houses, but rather their portfolio mainly consists of commercial properties with long-term leases. Think Home Depot, Lowe's, Walgreens, and other stores like that. On screen right now is a chart depicting their biggest clients, and as you can see, the tenants on Realty Income's property are usually big name brands, which is absolutely a good thing. These properties are in a variety of industries such as industrial, agricultural, and retail, and a majority of their investments are in sectors that aren't affected by economic slowdowns such as dollar, convenience, and grocery stores. In addition, most of Realty Income's investments are in sectors that aren't under threat by e-commerce nearly as much as other stores, which is also a good thing. For example, with Home Depot and Lowe's, most people who are renovating their house aren't going to be shopping for the materials online but would rather see it with person, and the same goes for the grocery stores. Their properties are high in demand and have a 99% occupancy rate, and 50% of their tenants are investment grade level, which means they have investment grade ratings from either Moody's, Fitch, or Standard & Poor's. In fact, over the past 2 decades, the occupancy rate has never fallen below 96.6%. In addition, the responsibilities are handled by the tenants themselves, meaning Realty Income doesn't have to worry about insurance, maintenance, or even property taxes. That is all passed down to the tenants. This allows the company to bring in a consistent cash stream on a monthly basis, which is how they are able to pay their high dividend, and since they are REIT, they are legally obligated to pay 90% of their net earnings to shareholders. Now that we've talked about their core business, let us talk about their dividend, as this stock is a REIT and a dividend aristocrat, meaning everyone who is investing in O wants the dividend income. This stock currently pays 5.71% annually, which is a quarterly amount of 77 cents. However, saying quarterly amounts is a little bit misleading. O stock actually pays monthly, which makes sense as rent checks tend to be month to month as well. This means that each of their monthly payments is a little bit over 25 cents per share. This is a great thing for income-oriented investors, as it not only speeds up the dividend snowball by an okay amount, but it also provides people with a monthly income which could help retired investors pay off their expenses more easily because they pay on a more consistent basis. I don't own any of this stock myself, but I can imagine that when you get enough of the stock for it to pay one full share a month in dividends, the dividend snowball will really get going. Now, let us talk about growth and the safety of this dividend. This dividend has been growing consecutively for 29 years, making the company a dividend aristocrat, and the company has increased on 121 different occasions over this period of time. The 10-year dividend growth CAGR is 4.28%, which is okay, but it has slowed in recent years to be closer to 3.5%. The dividend, though, does seem to be safe, as the cash is supported by long-term leases with reliable tenants. Throughout Realty Income's long history, they've never once cut the dividend, which shows this in full effect. This is one of the reasons Realty Income has been hailed the gold standard for REITs. They have one of the most reliable dividends in the entire sector and have the business model to back it up for a long period of time. Overall, they haven't yet cut their dividend, and because the price keeps dropping, the yield keeps increasing. And in terms of just dividend alone, this stock is very, very solid. Now, we have to talk about the less fun part about this company, the depreciating market cap. Within the past 12 months, the stock has fallen 15%, and from its peak this year, it is down over 20%. The reasons behind this is because of 2 main things: interest rates, as well as fear that Realty Income's main tenants aren't performing very well, such as Walgreens. The reason high interest rates affect Realty Income's stock price so much is because real estate businesses rely heavily on debt. Because REITs have to pay out 90% of their net earnings to shareholders, they often don't actually have enough money on hand to buy new properties or especially to build new ones. This means to do anything, they have to get capital from banks or other lenders, but because interest rates are so high right now, it is very difficult to get loans that won't be bad for the company in the long term. This has put a slowdown on the rate that Realty Income can expand by a drastic amount. Also, many investors are worried that some of their main tenants who aren't doing very well might struggle to pay their rent. At the end of the day, though, this is nothing more than short-term pressure. Even if their larger tenants are unable to pay their rent, which is very unlikely, in the long term, Realty Income shouldn't have a very hard job replacing these companies because their property is in high demand, as I said earlier. In addition, the interest rate issue is also short-term, as when interest rates fall back to a normal level, they will be able to expand at a quicker rate once again. This means that, in my opinion, this stock is trading at a ridiculously cheap price. It currently trades at a price to AFFO of 13 times, which is historically low, as in the last 10 years it has traded at a price of 19 times. This makes it the cheapest it has been since the pandemic began, and if a pandemic cannot kill the retail stores that Realty Income leases to, literally nothing can for at least the foreseeable future. The stock is also at the same price as it was in January 2016, which means this entry point is the same as it was almost 8 years ago. Lastly, stock slumps aren't new for Realty Income. Between 2013 and 2014, the stock slumped tremendously. This also happened in between 2016 and 2018, and the pandemic obviously shoved the stock very low. All three of these times were scary for investors, but the company continued to grow its dividend during times of uncertainty, and every single time this has happened, it has made for a great buying opportunity. That is why I think that this current situation is largely the same deal. I see people all over the internet, on YouTube, on Reddit, etc., talking about how O stock is scaring them, but really you just need to hold. If you buy shares in this business, you are buying a very stable rate with a good balance sheet. Continued losses could remain for the short term, especially depending on what the Fed does next, but in the long term, this is probably a great buying opportunity for income investors, and for people who are down on their investment already, I wouldn't worry that much. In total, for growth investors, Realty Income may not be the best choice for you, but for people who want a high dividend amount, especially one that pays monthly, Realty Income has been the gold standard for companies in this sector. I've never owned a stock that was a REIT, and I've never owned Realty Income, but to be honest, this current price point is intriguing for me, and I don't even like these types of companies that much. So if you're worried about the short term, that's okay, but if you're worried about the long term, I just would ignore it right now and try to get your mind off of the stock price. Anyways guys, thank you for watching this video. If you agree with my consensus, let me know in the comments, but if you disagree, also let me know that. Do you own any Realty Income stock yourself? I'll be interested to know how many of my subscribers do. Thank you all for continuing to support my YouTube channel. I am looking forward to hitting 1,000 subscribers soon, and I appreciate all of you guys. Also, sorry for my voice, I am still a little bit sick, which is why I sound probably a little bit nasally, but I hope it's okay. See you in the next video. Goodbye.